Rohr here with an early global view on Tuesday, January 20th, 2015. It is currently 7 a.m. U.S. Central Time. Coming to you just a bit later because there was a lot to look over coming back in from the MLK Day holiday on Monday. And the first thing is there's a lot of macro influences, but most of all, the IMF downgraded its world economic outlook by 0.3%. Everybody except the U.S. got downgraded, even though they made a point that lower oil prices were going to generally help the world economy across time. So, what does all this mean to the markets? Well, the anticipation of more QE, where the IMF World Economic Outlook suggested strongly that the central bank accommodation be maintained, not surprisingly, has been good for equities, and as equities go up, in spite of the expectation of quantitative easing that'll include government bond purchases by the ECB, the govies are suffering just a bit. So we're looking at the S&P 500 future hourly on the left, 30-minute on the right as usual, and this market is up 12 right into 2025. And this is not a huge surprise. As you know from our assessment last week, we had said that this trading low back at 1984 in front of the FOMC minutes on Wednesday, this was Tuesday's low going back 2 weeks ago, we had a sense that the market would be good from there, and that was, of course, because it was the pre-FOMC statement and press conference level from which the market pushed up back in mid-December. And therefore, it's a big psychological level. Technically important, yes. It's the old high from back in July of last year, but psychologically on recent form due to the FOMC connection, very important what the market did between 85 and 78. You can see a bit of sagging below 85, but ultimately was good going back to Friday because, of course, we were off yesterday. So this is Friday's close and a fresh upbreak out of the current ranging swing from 202. So 202 to 205 becomes an interim level now this side of 1985 to 78. And the higher resistances, even above 2025, an important interim level, remain up at 2036 to 40, and again at 2050, from which the market failed so badly after the down break out of the upward channel from back on Employment Day in the U.S., back on Friday the 9th. So 2050 remains a big level, and there are other resistances above that. What's very important here is the degree to which the push-up Friday through the day took away that downside runaway below the lower runaway band on the hourly MACD. As of Friday's close, the 30-minute MACD was out to the upside. Important to just how far this market might proceed on the upside the next couple days is whether this morning's gap higher and any sustained strength above 2025 will re-encourage a push above the upper runaway band on the hourly chart. And that pretty much does it for the short-term view of the S&P 500.